So it was a Saturday night. I was on Seeking Alpha, researching a bunch of different ETFs, trying to gather some information, get some video ideas, and I came across this article right here. The article is titled SCHD, a SPY substitute for ETF investors. Now, of course, I view SCHD as a very high quality investment, but I've never looked at it through the lens of replacing the S&P 500 inside of a portfolio. I'll leave the article linked down below if you guys want to read it, but he essentially says that with the current market situation, rising interest rates, the conservative dividend-paying ETF could potentially perform better in the coming years. So needless to say, that article is very thought-provoking, so I conducted my own research to answer the question, is SCHD actually a good replacement for the S&P 500 given the overall macroeconomic conditions? But before jumping into this, if you guys enjoy my content and what I do here on YouTube, let me know. Leave a like, subscribe, share the video. It really does help me out a lot, and I greatly appreciate it. But let's get into this. Okay, so first thing first, I want to quickly explain why in this current economic situation, these value companies might perform better than, say, growth companies. And to put it simply, when cost of capital increases, aka the interest rate goes up, companies that are cash rich tend to be in better positions. I think that makes a lot of sense to most people, and right here is Apple, and they're a great example of a cash-rich company. They generate a lot of money, and they return some of that to the investor in the form of direct dividend payments. In fact, Apple is raising their dividend almost 10% per year, and their payout ratio is actually decreasing as they do that because they generate so much money. So in a rising rates environment, a company like Apple is not going to have any issue acquiring cash in order to reinvest it and grow. And the second main factor here when it comes to the prices of equities when interest rates go up is the discounted cash flow model. And to put it simply, when the current interest rate goes up, the future cash flows and earnings of a company have to be discounted more. And that has to do with the opportunity cost of just putting your money today in a treasury bill. And the discounted cash flow model still does affect companies like Apple, although to a much smaller degree because of their great financial independence. And not to mention, dividend-paying companies like Apple tend to have smoother returns for the investor because in comparison to the price, the dividend is way more reliable and stable. And that brings us back to SCHD because this is a collection of cash flow rich dividend paying companies. Okay, now in terms of the actual construction and methodology of SCHD, the main factors are the minimum of 10 consecutive years of dividend payments, as well as some financial metrics like free cash flow to debt, return on equity, and the dividend growth rate. Now in contrast to that, the S&P 500 is constructed very differently. So the index is currently made up of 505 largest publicly traded US stocks using a free float market capitalization weighting method. And if we come over to this tool which shows us the overlap between two different ETFs, there's only 11% commonality between the two. Now this can be a little bit misleading because SCHD only has 105 holdings and the S&P 500 505. So over half of the holdings in SCHD are in the S&P 500. And taking a direct look at just the price performance of these two assets over the past 5 years, they do move pretty similar to one another. And during this time, the S&P 500 is up 87% and SCHD is up 75%. But that of course is just the price history. So that's what other people value this asset as. The direct dividend payments end up being a very important source of the overall return of these assets. And here the S&P 500 is about 1.5% and SCHD is about double that at 3.18. And that's why if we come to this tool which shows us the total return of these assets along with many other metrics, we can see the CAGR or the compounded annual growth rate of these two assets end up being very similar over the past 10 years with a difference of 0.5%. And this is the visual format of that over time. And I like this chart because this breaks it down by year. So SCHD is in blue and red is the S&P 500. And there's some years like 2016, 2013, 2011 where SCHD noticeably outperforms, and then other years like 2019 and 2012 where the S&P 500 does a little bit better. So they're very similar, but if we come to this page, technically, SCHD is slightly less volatile, but only slightly. The biggest difference between these two ETFs is simply the level of income that they generate. So this simulation is what happens if you invest $10,000 in each, and we can see here in the beginning, SCHD generated $313 and the S&P 500 $249. But due to the higher starting yield as well as the faster dividend growth rate, the difference becomes a lot bigger over time. And these larger direct payments is what closes the gap between the price performance of these two assets, ultimately giving them that very competitive and comparable CAGR. Okay, so in terms of the performance data between these two funds and considering the macroeconomic situation we find ourselves in, I would say, yeah, SCHD could be a good replacement for the S&P 500 over the next couple of years. The ETF is full of cash-rich dividend-paying companies, and these direct dividend payments really helps to smoothen out the return of this asset over time, regardless of what happens with the price. But aside from just the performance, there is another aspect you have to take into consideration, and that's your exposure to different equity classes. So the S&P 500 is pretty evenly split between large cap growth and large cap value. And that makes it a pretty good all-in-one investment. SCHD, on the other hand, as you might expect, is tilted very heavy towards the value section. It still does have roughly 15% in large cap growth, which is good, but long term and across multiple economic cycles, this is going to be a limiting factor. Although it's also why in the short term, SCHD might perform better. If we come down and look at the sectors, over 20% of SCHD is in financials, and financials perform the best in a rising rate environment. And in comparison to that, this is the S&P 500, and we have a lot more exposure to technology and growth. So that's why, even though the aggregate total returns of SCHD and the S&P 500 are very comparable, and in the short term it is poised to potentially do better, due to the lack of allocation towards growth, I don't think it's a long-term solution or replacement to the S&P 500. In my view, if you both want a more dynamic portfolio and to replace the S&P 500, I think a combination of a value ETF like SCHD, as well as a growth-focused ETF like the Vanguard Growth ETF, is a great combination. And this investment has 93% of his assets in large cap growth and another 4% in mid cap growth. And the funny thing is, if you combine VUG with SCHD, it kind of creates the S&P 500. But by splitting it up into two different ETFs, that allows you to control the allocation to better fit the market cycle. In fact, using this tool, we can actually combine these two ETFs into one portfolio and see how it stacks up against the S&P 500 directly. And here's the performance over the past 10 years. The blue line is the combination of SCHD and VUG. Down here we have the returns annualized, and finally the income level. And even with SCHD only being half the allocation, the overall income still is higher than the S&P 500. And if we come over to this page, the 50-50 split between growth and SCHD actually ends up having less value than the S&P 500. And this is the point in the video I want you guys to leave a comment down below and let us all know if you think SCHD can be a good replacement for the S&P 500, or at least in this current economic situation we find ourselves in with the rising interest rates and rather high inflation. I'm excited to read those comments. If you guys enjoyed the video, leave a like, subscribe, all that kind of stuff, and I'll see you guys in the next one.